Well, hi there. So in this video, we're going to learn all about the basics of banks, how they work, and how bank lending creates money. Let's get started. Okay, the first thing to understand about banks is that they're actually part of a larger group of what we call depository institutions. They accept deposits. That's literally all that means. And there are other types of them besides banks. There's things like credit unions. There's things called savings and loans. There's a variety of depository institutions. In this class, we'll just kind of collectively call them banks and not really worry about the fine detail differences. But there are differences between what they are. What the financial sector does and what banks do is they match savers with borrowers. That's really all they do. That's their primary function. Their reason that they exist is they take money that people have saved and they match it with people who want to borrow money. So they perform an essential function actually in society. When in the last unit we talked about the marginal propensity to save and the marginal propensity to consume, the amount that's saved, we just kind of said, like, I don't know, it disappears. It doesn't disappear. It actually gets transformed into someone else's loans. And in fact, the process by which banks accept deposits and make loans is a really important part of how the money supply changes. So let's kind of dive a little bit farther into how banks actually operate. Banks operate under something called fractional reserve banking. And that means they keep a fraction of your deposit in reserves. They keep a proportion of what you deposited in the bank vault, or they keep it electronically in their own bank accounts, but they definitely have some of your money stashed away. They keep it on reserve. The rest they lend out. So they make money by taking some of your money and lending it out to other people and charging those people at interest rates higher than what they pay you when you deposited your money. That's basically their premium for matching you, the saver, with the borrower who wants your money. Now, regulators will often tell banks you must keep some money in reserves. We call that required reserves, kind of a duh name. The required reserve ratio is the percentage of demand deposits. I want you to put a star next to that part, not savings. It's not savings accounts and not CDs, not those time deposits. So it's just the checking account money that actually is part of the required reserve. The idea behind that is that people aren't often using their savings accounts and pulling lots of money out, putting lots of money in. It kind of is a more stable population of money, but checking account money is lots of in and out. And so the government has an interest in saying, well, banks, you probably need to keep some of that money in reserve just in case you get a bunch of people who come in and want to withdraw their money all of a sudden. So banks sometimes will kind of ride right up against that required reserve ratio, but most of the time banks hold what are called excess reserves. That's just extra money that the bank has chosen not to lend out. They could lend it out, they just have chosen not to. They're going to hang on to it and not lend it out in this given minute, right? Now in the United States, for many decades, they had 10% or 15% was the required reserve ratio. For the last couple of decades, the U.S. required reserve ratio is actually zero. So just in full disclosure, this is not really a tool that bank regulators in the United States use anymore, but we still have other types of those types of requirements for banks to ensure that they have enough money that can satisfy depositors. So there are similar kind of backstops that exist in the real world. This is just more the original kind, the OG, if you will, and it's a pretty simple one to understand. It's the percentage of checking account money that the bank must hold, and sometimes they hold extra, which we call excess. Now, banks often organize their kind of money into what we call assets and liabilities using what's called a balance sheet. And a balance sheet looks like this. It's literally just a balance. A T account is sometimes what it's called because it has a big T in the middle of it. And it balances assets with liabilities. What is owned by the bank, right, to be clear, by the bank, and what is owed to the bank, or by the bank, excuse me, what is owed by the bank. So owed by the bank, owned by the bank. This is the bank's balance sheet. And it may seem a little counterintuitive at first, but let's walk through what these actually are. Now, assets, we already defined in the last video that those are things that have value that are owned. And so required reserves and excess reserves, this is just reserve money, right? And we would add them together and you get total reserves. That's how much money the bank has basically on hand. It could be money in the ATM, it could be money in the bank teller drawer, and it could be money electronically that the bank is storing electronically in their own bank account with another bank. So this bank has $1,600 in reserves. Now, they also have $1,000 of loans. This is money that's already lent out. Already lent, to be clear. Right? They could loan out this 1,500 of excess reserves. They already have loaned out 1,000. And you might be thinking that's weird that we'd say that that's something of value that's owned as an asset, but it's something that's basically a value that the bank has. And they could give that to someone else or sell that to someone else and make money on it. Another type of a loan is a bond, and it's something of value that the bank owns. And again, they count it as an asset. If we added up all of the assets of this bank, in addition to their equipment and property, we'd get $4,000. Now, on this side is what the bank owes. The bank owes to people, typically, the majority of their liabilities are what we call deposits. It's the money that's deposited at the bank that at any moment you could walk in and say, I want my checking account money. Or at any moment you could walk in and withdraw your money from your savings account. Certificates of deposit, those are that special type of savings account. And so you can see that this bank has $3,000 worth of liabilities. Now, I put here total liabilities for because this thing, owner's equity, this is really just a way that assets and liabilities are balanced. Another way to think about it is actually this is the value of the bank itself. In a way, if we said, well, all these things are what the bank owns that has value, and this is what's owed is the 3,000, well, what's the value left over is $1,000. And in fact, if we were to divide that into, say, 10 shares, we could actually own the bank, right? We could have shares of stock in a bank. Then each share should technically be worth $100 because it's actually the value of the bank itself. If we were to pay off all of our liabilities, and what would we be left with? We'd be left with $1,000. That's the value of the bank. Now, it's really just saying assets minus liabilities equals equity, right? But a way to kind of consider that often they're written out is that the equity is listed as the last thing on the liabilities side. So it's not maybe technically considered a liability. It's not something that's owed, but it just is the thing that's left over. Now, some students who are kind of more eagle-eyed might be like, well, what happens if they owe in liabilities more than they own? Right? Imagine that like somehow you got into a position where as the bank, you had lots of deposits, but you didn't have very much in assets. Well, your bank would be bankrupt. That's what we call a bank failure. So when the value of the bank goes to zero, when the owner's equity is actually zero or negative, your bank is bankrupt and it's no longer a functioning bank. Now, this is really more just for you in class. If there's things that you're not sure what these words mean, it's a good chance to get them answered. But often you'll get a question like this: what's the required reserve ratio for this bank? So let's take a look. What would be the required reserve ratio? Well, just a moment ago, I told you it's the fraction of demand deposits required to be held. So how much are they required to be held? They're holding $100, and it's the fraction of the demand deposits. So 100 over 500, 100 over 500 is equal to 0.2 or 20%. And so where are those coming from? That's the 100 and the 500 that's right there. Now, given the balance sheet, how much more can this bank lend out? Not how much has it lent out, how much could it lend out? That's our excess reserves. We just look right here and go $1,500. Excess reserves. Now, the second concept that's related to banks and kind of understanding them is that bank lending actually creates new money. Every time a bank loans out a dollar, it's actually going to create a brand new dollar out of thin air. I know that many of you are going to be uncomfortable with the words that I just said, so I'm going to say them again. Every time a bank makes a loan, it literally creates new money out of thin air. It's brand new money. Think about it this way. I deposit $100 into the bank. Then the bank takes 90 of those dollars and lends them out to you. Now you have $90. Do I have less money because you have $90? No. I look at my bank account. I still have $100 in my bank account, right? I do. And if I want to pay somebody, I can electronically transfer those funds and they go somewhere and I don't know what they do with them, but I buy something with them. I still have $100. You have $90. The moment that the bank lent you $90, 90 new dollars got created. And there's an easy way actually that we can figure out how much total money might get created through all money lending that would be created. So I could make a deposit and then you get money from a loan, then you take some of that money and make a deposit, and then another loan gets made, and then money gets deposited, and then another loan gets made. And so there's actually a sequence of money creation that happens anytime someone makes a deposit and then the bank lends out money. The size of that massive, that expansion is something that we can calculate using something called the money multiplier. The money multiplier is simply 1 over the required reserve ratio. So our required reserve ratio a moment ago was 0.2. So in this case, it would be 5. So money multiplier is 1 over 0.2 is equal to 5. And if I actually started out with the bank just lending $100, well, the $100, right, the first loan times the 5, which is the money multiplier, is equal to $500 of new money, all new money. Now, if we were to not include that minus 100 equals 400. And so kind of thinking about like what's the original amount of the first loan, there's sometimes you get questions that are like that. But this is really the most important part, right? You take the initial loan, the first loan that gets made, you multiply it by the money multiplier, the total amount of new money that's created would include the first, obviously, is typically the 100. But if we just said not including the 100, then we subtract it out, right? I know that this sounds like it's kind of witchcraft of some kind, right? It's really not. This is just a function of how banks actually operate. And so the amount of money that actually does get created, though, is often much less than what this money multiplier would predict. Two simple reasons. One, banks hold excess reserves. They don't always maximize how much money they lend out. They will sometimes hold on to it. And if they choose to hold on to excess reserves, then you wouldn't get to borrow as much. And so the money multiplier would actually be smaller. The second reason why the money multiplier doesn't often create these huge expansive increases is because people will hold on to cash. Businesses will have money in their teller drawers, right, in their cash registers. You will hold money in your wallet. And not all the money being redeposited into the banking system means that sometimes when you make that first loan, then some of that money is going to get held into cash and it won't create quite that large expansion of the total amount of money supply. Now, the last question on this page is, given the reserve requirement and the excess reserves that are listed up here, right? So from up here, if the bank were to lend out its excess reserves, what's the maximum possible increase in the money supply? So let's say this bank decided to take its $1,500 of excess reserves and make its first loan, right? That's its excess reserves. If they were to do that, well, we know the money multiplier is 1 over 0.2. That was 5, right? That's our money multiplier. And so we take that times 5. 5 times 1,500 is $7,500 of new money. Now, an important part of that is to know that the excess reserves were already part of the money supply, right? They were already being counted. So maybe new money might be better to think about like, well, it was only more like $6,000 of new money, brand new, not including the excess reserves. So the original, I'll say the original reserves. So sometimes you're just going to get a question that's like, hey, make sure you don't include that amount, or you do include it. You just got to be paying a little bit close attention to see. Are they talking about the total of change, maximum possible increase? That's 75. If it doesn't include this original, we would say 6,000. Hopefully this helped you understanding how banks create money through the process of making loans. Literally, they make a loan, new money gets created. Also understanding balance sheets and the required reserve ratio. I'll see you next time.